back to the channel, everyone. In just a second, I'm going to play a few CNBC clips from today's episode of the Halftime Report. I'm going to pull up the charts and dive into the technicals of some of the mentioned stocks. We're going to look at the key support, resistance levels, momentum, and see if the price action actually backs up what the talking heads are saying. Hit that like button, subscribe if you haven't already, and let's roll the tape on the first clip.
All right, guys, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, this record-setting market. Stocks on a 3-week winning streak, but are investors growing too bullish? We'll ask the committee. Joining me for the hour, Joe Terranova, Shannon Sikocha, Jim Lebenthal, and Stephen Weiss. Check the markets here. We obviously have a little bit of a give back today on everything but the NASDAQ, which is green. So we're 3-week winning streak. The VIX fell to its lowest level of the year on Friday. Every sector within this market is now in the green for the year. Ed Yardeni had already taken his target to 8,400 for 2026, says we're going to 10,000 or beyond by the end of the decade. The roaring 20s in full effect. Why? Because earnings are amazing. Evercore this morning. Long-term stock market trend continues to be higher. We have the potential for a FOMO-driven overshoot. SPX 9,000 is attainable in the next 12 months, even if you don't overshoot on a valuation standpoint. Joe, what say you?
I think you can get to 10,000 in the next 18 months. I see no reason why not. I agree with the representation of earnings being at really a historic pace for the last 7 quarters. The market is kind of settling in as you move towards the back end of August. I think I'm hearing a lot of people say, okay, look at the market and maybe this is the opportunity to sell. There's universal bullishness and that's the reason to sell. And I couldn't disagree more with that. I think really what's happening as you move towards the end of August is the market's becoming more tactical. Okay, the market is identifying opportunities and maintaining those opportunities. So memory came back last week. Optical came back. We're maintaining that position. We're rebuilding positioning. The bullish momentum remains in place. Energy, we've spoken about the refiners. Same example there. Rebuild positioning, maintain positioning. And then financials. Look, once again today I'm looking. You've got Bank of America, 52-week high, State Street, Charles Schwab, PNC. So there's strength in financials as well. The market is more tactical. And just because it appears as though maybe volatility and the environment is a little bit slower, the market's not moving as fast, that is not a reason to sell. That's actually indicative of a market that is waiting to reaccelerate as we move into the fall and broaden out once again.
Okay. Thankfully, Weiss is not maintaining his positioning because he is no longer blending in with the wall. So we appreciate that. Appreciate you putting a new piece of art up, Weiss. What about you on this market? Yardeni, 10,000 by the end of the decade. 9,000 by the end of in 12 months for Evercore, 10,000 from Terranova. People are pretty bullish. I asked the question, too bullish or just right?
You know, I'm bullish as well, and I tried to think of what can derail the bullishness. We know earnings are good, and there's every reason to believe they'll accelerate. A lot of it driven by AI. So what are the obvious things that could hit it? Number one, if rates go up measurably, if the Fed starts tightening, and that'll be because of oil, or the consumer, which is still 2/3 of the economy, starts to weaken further. Now, I think the market's going to look both past oil and the consumer because it's really one and the same thing. So I am bullish, and of course there's always the AI trade, which right now shows no sign of easing up. So yes, I'm in agreement the market could move higher, but I do think there's some risks out there, which I just named, which could derail it a little bit, but I don't really see any disaster.
You know, what Deutsche calls this current equilibrium. Do we think that's sustainable?
Yes, but for how long is the question? And I would say certainly through the end of the year. And the equilibrium that I see, and Shannon, I think you were pointing this out, is that the multiple, roughly 21 times next year's earnings on the S&P 500 is very reasonable for the growth rate that we're having in earnings, mid-20s%, even if you strip out the one-timers. The problem, and I'm not going to say the problem, but the thing to consider is that growth rate of mid-20s% is not going to last in perpetuity. That's why I'm not that comfortable going as enthusiastic into 2027. Let me be clear. I am not suggesting selling stocks. That's not my point. My point, though, is that over the last 4 years, including this year's, we've had well into double-digit percentage returns on the S&P 500. And I think that will continue through year end. But I think the bar for growth of earnings becomes much higher in 2027. We're looking at, roughly 14% earnings growth next year. And the slightest disappointment to those numbers could bring the multiple down. Now, let's be clear. We're talking about earnings growth and a market that should be going higher. But I think it's tough to predict a fifth year of double-digit gains. It's only happened once. The late 90s.
Why aren't people talking about, guys, give me the 30-year, please. Why aren't we focused and fixated more on that, the 30-year Treasury, which is now at 529? Okay,
So,
Warsh comes out of that Fed meeting, right, and reveals the fact there were 3 dissents. The talk seems to be much more hawkish, even though the action didn't match the rhetoric. Nonetheless, the 30-year yield shoots higher. We continue to have a lot of issuance coming on the market, right? These debt raises from the hyperscalers, among others. The concerns about the deficit and whatever other issues you want to suggest are leading to the fact that the 30-year yield continues to rise. It doesn't matter?
For now, it doesn't matter, but I think you're onto something, Scott. I do. I don't so much think it's the 30-year that matters as it is the 10-year. The 10-year, as I think we all know, has been in a range of 4% on the low end to 5% on the high end for about 3 years. And we do have to wonder if what the 30-year is doing is telling us that the 10-year is going to go higher. And if it goes above 5%, that could be a way of the world saying, listen, we're not going to finance indefinite deficits, whether it's at the federal government level or at the hyperscaler negative free cash flow level. But I want to make this point clear as well, that while it is wise of you, Scott, to bring up that question and for us to discuss it, this is not an action that somebody should take now, at least in my opinion. Somebody should not look at the 30-year at 5.29% and say, well, that's it. I got to get out of all of my hyperscalers because higher interest rates are here. What the interest rate environment is reflecting is that there is greater uncertainty with Kevin Warsh, who is speaking much less to the media.
It does, Shan, raise a question of, whether this is an opportunity to increase your exposure in bonds, or if it's too early because you still think that yields are going to back up even further. I hear some people suggest that this is a generational opportunity, potentially, the way that the 30-year has backed up.
Yeah, and curve steepening is not getting the attention I think that it deserves. But I think that the reason why is that for right now, I think the equity markets in particular are looking at real rates rising as an indication of growth. You start to think about that in terms of inflation or valuation stress or that greater issuance, then it starts to look a little bit less tenable. But the overall steepening of the curve gives you as an investor significantly more latitude to add incremental duration, a couple of years, lock in some nice yields, and then potentially benefit if, like we expect, the Fed doesn't hike this year. You're going to see that come in as you get closer to December, and you could have already locked in what have been much more attractive yields than they were at the start of the year.
And especially if the next move is, if the first move of the Warsh Fed is a cut, not a hike. And I don't count a pause as a move. It's more clear to me of either a hike or a cut.
I think we're all puzzled why the equity market and risk assets have not responded to the rise in global yields, not just U.S. yields, because global yields are rising. And I think that the common denominator is the absence of the volatility. There still is not elevated bond market volatility. It's a very gradual, orderly increase. The corporate debt market spreads remain tight, offerings, strong demand for them. So I think at the point where the velocity of the move intensifies, then it becomes troubling. Then it becomes something that you have to worry about. I still think, by the way, if you define 2026 and you say, where does the correction come from? It's not on rising yields. It's not on rising oil. It's any time the momentum factor breaks down. When the momentum factor breaks down, the market rolls over, and the momentum factor, a day like today, you have the S&P equal weight bolt down, momentum factor's higher, the market's comfortable.
Yeah, you know what it does when that happens? The market sort of resets and rebuilds, Weiss, right? It's done that on almost every occasion. When momentum has rolled over, it's felt a little dicey for a few days, maybe a week. but then it has rebuilt itself. I'm not sure what the MTUM is showing today. The Joe T's at a 52-week high. I saw that this morning when I looked, and that's as representative of this trade as anything else. So is that, obviously, right there. That's one of the reasons why people are feeling pretty good, because there's a lot of stuff going up.
Yeah, I think we have to be careful of saying that past will not be prologue in some cases. Rising rates and a steepening yield curve, rising rates always compress equity multiples because the future growth is not going to be there as it was before rates went up. And to attribute this market, it's always going to be a momentum market, I think is a mistake. To your point, however, and I've been talking about this for years now, is that it's a completely different investing cohort that's driving it. If you take out everything that's in passive money and you take a look at who the investors are, they are used to V-shaped recoveries. So until further notice, the 10-year catch-up trade that we saw post the 2000 bubble bursting, those are things really, they're relics. We're not going to see those again for a long time. So it's going to be V-shaped recovery, which, Scott, to your point, is a reset. So, but I think at this point, as I pointed out in my initial comment, rates are the risk. We don't need Warsh to come out and say raise rates, because he's saying the market's going to do it for me, and that's exactly what's happening. So the market's not completely ignoring it. To Shannon's point, it's largely ignoring it, but that's why we're seeing financials move up, because they've got more of a spread to capture.
The momentum rollover recently, I think you could make the case, was arguably the best thing that's happened to this market in a while. Mm-hmm. Why? Because it cleaned up positioning. Mm-hmm. The playing field got a lot cleaner. There was a lot of excess leverage in the system. Not to say that it's all dissipated, but nonetheless, it definitely cleaned up the environment.
100%. And we're looking right now at the momentum factor. It's up 8% on the month. That has been the story. Look, I still believe market structure has changed dramatically. I know Steve would agree with me on that. So with the increase of all these quantitative strategies, the momentum factor, I think, is going to become even more important. But I also believe your point on positioning is a really strong one, and I think it's valuable to understand where we are in positioning, because I think that's a leading indicator where markets ultimately are going to be going. Just as an example, take the Mag 7, okay? Take the Mag 7. Where were we 3 weeks ago? The story was about Alphabet. It was about Apple. I was building a position there, and NVIDIA was kind of asleep. Mm-hmm. Now NVIDIA has awakened ahead of earnings, and it's on positioning. It's getting in front of earnings. It's building the position on the expectation that this is going to be a remarkable quarter. Positioning so incredibly important right now to understand.
Jimmy, NVIDIA is up 12.5% month to date. To Joe's point about awakening. Tech, by the way, is on a roll. The sector's leading this month, 7.5%. And it's no surprise, I suppose, that even on a relatively ho-hum market day, that the NASDAQ is green. That only seems to make sense. Microsoft's been a nice winner this month, as has Meta. Joe said, NVIDIA reports its earnings in a little more than a week. They reportedly are downsizing their plans for the $250 billion guarantee of the OpenAI data center. That's just a news item that's there today. But this stock's back, and tech is having a nice little move again.
And today it's chips, really, within tech. We can see what's happening with Micron, with SanDisk. And I think it's very interesting, in light of what we're just talking about, how the narrative changes as the price changes. Our friend Scott, Chris Ferrone, I know you have him on the 3 o'clock show quite often. He has a phrase that narrative follows price, and I think it's very accurate. Because just go back about a month, 5 weeks ago, when the chips were down and the narrative was, following the decline in chip prices, that peak spending was here, or at least peak spending was being anticipated by the market. Now that has dissipated as stocks like NVIDIA and Micron recover. And that should be the case, because if you get away from the narrative and just look at what the actual drivers are, there is a ton of spending going on in data center. It shows no let-up. Roughly $800 billion for the top 5 hyperscalers this year, going to $1.2 trillion next year. Wall Street Journal today has an interesting article about the off-balance sheet spending steepening that's going on that adds about another $2.5 trillion to that. The point being is if you look at the fundamentals and forget about the narrative that's following price, you will be enthusiastic about NVIDIA at roughly 20 times earnings going forward and an earnings growth rate of around 30-35%. I think you can put new money to work in NVIDIA right now.
Well, I think that's exactly what people are doing. People that were anchored to building the position in Amazon, in Apple, in Alphabet, which were the leading
like
Mag
Berkshire?
7 year to date.
Like Berkshire?
Right, like Berkshire. Right now, you're looking at an upcoming earnings report where the revenue growth reaccelerates back into the 90% level. You're looking at margins at 75%. They're going to guide to a $100 billion quarter in Q3. You have to build long position. You can't sit on the sidelines and not have that long position going into the earnings. So I think that's ultimately what's happening. And it's interesting because there's the internal Mag 7 rotation, okay? I said this, NVIDIA is the leading Mag 7 year to date. The next three best performers are Alphabet, Amazon, and Apple. Each one of those three Mag 7 stocks are down in the month of August. It's an internal rotation. Money going out there, going into NVIDIA.
Is it strange to you, Jim? Let me see Alphabet again, guys.
Yep.
Whatever chart you just put up for me, please just put it back up because I forgot what that was showing, but I want to see it again. I think it was August or whatever that was. Thank you, by the way. So is it strange to you that we learn of Alphabet, we learn of Berkshire increasing its position in Alphabet, and I think it was August, guys, and the stock not really getting much response. Whereas in the past, you can only assume that if you come out and you say, hey, Warren Buffett and Berkshire Hathaway are increasing their stake by a fairly large amount in Alphabet, the stock looks pretty good.
So there's a lot in what you just asked. Is it Greg Abel or is it the chairman? Is it Warren who's making these calls? And I think the market doesn't quite know. And if it is Greg Abel, he still has a track record of stock picking to prove. I think that's item number one.
That's kind of the point I'm making is that the market has already sort of adjusted to the Buffett premium, if you will, leaving the market.
Okay, that is
right.
So that's actually what I was trying to say, that if it were Greg Abel, it's not going to get the premium that had it been Warren making the selection.
Well, one has to assume that it is Mr. Abel at this point.
Fair enough.
That it was Warren Buffett who initiated the position, as I recall he told Becky, right? But now from this point, it's like, so if Abel owns it.
So if there is no Warren premium, there are other cross currents that we need to consider. Yes, a year ago, Gemini was the leader in the large language model. And since then, over the last year, even shorter than that, it has become others. It has become Claude, and it's sometimes OpenAI. So that bloom is a little off the rose. Bear in mind, the stock also is up massively from then. And then, Scott, as you pointed out, I guess it was 2 weeks ago, we have had a diaspora of talent in the artificial intelligence division at Alphabet leaving. And the stock has been heavy since then. I didn't want to believe it. You and I had a conversation that day that it happened, and I thought this was an overreaction. Well, it turns out maybe it's not an overreaction because the stock has languished since that announcement.
Well, no, I dismissed it as well. You were 100% correct. We could walk through this.
Who was?
You were 100% correct. Wednesday, August 5th, 384, all-time high in the morning. 384, all-time high for Alphabet in the morning. At around 11-something, we get the announcement about the chief scientist leaving Alphabet. The stock falls from 380 below 350. We discussed it on air. I dismissed it. Jimmy, you dismissed it as well. The stock has not been able to rally since.
Now, in its defense, 80% web services growth year over year.
I understand that. Absolutely. We understand the fundamentals.
I think you're overreacting to people leaving, is my view. You know,
good. I want you to be right.
Well, Jim Chanos used to keep a list of all the employees, senior employees that left Tesla, and started keeping that list. I think at about 100, and then maybe earlier. And then look what happened to the stock. So you have to assume, we heard the same thing with Goldman all the time. Oh, so-and-so's leaving, so-and-so's leaving. These companies have deep benches. They're not stupid. You don't know what the real reason is for that person leaving. Was the person pushed out because the people below them were chomping at the bit to move ahead? Did
Yeah,
the company believe they
I
were
don't know.
on par?
I don't think that Alphabet's AI division or whatever even smaller area is the same thing of talking about a firm the size of Goldman Sachs. I mean, there obviously is
No,
brain
that's true.
drain. There is brain drain concern in that area. And by the way, and we'll get to another story in a second that seems to be going through the same issues. But I'm not sure that's a great comparison.
I'm not belittling the brain drain. Yeah, I'm not belittling the brain drain. Clearly, people are leaving that are accomplished there. What I'm saying is that companies have a way of getting through this, particularly the bigger companies. Take a look. When Johnny Ives left Apple, we thought, oh, the stock is dead. Never gonna create a new great design on its devices. So companies do this over time. It happens. So you should pay attention to it, but you also got to know what's behind it.
Well,
and that we just don't know.
Hey everybody, welcome to Blue Cloud Trading. I'm George. We just saw the first segment of the halftime report. I'm going to show you guys the second segment as well as some clips from Closing Bell. Josh Brown's going to be on Closing Bell for the first time in a while. And we're going to cover the stocks that they discuss right after the video clips. So why don't we do this? We're going to first, I just want to show you guys how the markets were basically closed today. It's currently 5:32 p.m. as I'm recording this video. S&P 500 was down 0.52%. The NASDAQ was down 0.32. Dow Jones was down 0.51, and the Russell 2000 was down 0.34%. There's not a whole lot of interesting things happening as far as the economic calendar is concerned. Tomorrow, I guess, are probably the building permits, and you've got the housing starts. So that's probably going to impact the real estate sector, I'm going to guess. And then we're going to see down here on Wednesday, that's the FOMC meeting minutes. That's going to take place at 2 p.m. That also can have some impact on the market, so just keep that in mind. But Thursday, relatively zero impact almost from the different earnings, news, and same thing for Friday. So it's a pretty easy week. Now, next week, however, if we look at next week, we've got Wednesday, August 26th. There's quite a few things happening there on Wednesday that could certainly impact the market. So just keep that in mind. And then following that, on Friday, we've got the non-farm payroll annual revision. Okay, so let's go back. I just want to show you guys one more thing. The heat map. This is how the market basically closed today. You can see the Microsoft, Oracle. A lot of the infrastructure software was down today, but the semiconductor equipment stocks were up. Computer hardware was up. You got the communication, some of these communication services companies, communication equipment companies doing well, and electronic components. Healthcare stocks did well today. All right, the healthcare plans did not. Medical devices, not so much. But energy stocks were up again. And that's mainly because of what's happening in the Strait of Hormuz. The U.S. stocks closed lower as rising oil and long-term yields tied to the U.S.-Iran tensions offset the chip strength ahead of the retail earnings and Fed minutes. So let me show you guys what we're going to talk about. There's about 17 ticker symbols here. Not all of them that were discussed, but that's quite a few from this most recent clip that we just saw. All right, you can see NVIDIA, all right, Apple, Amazon, Google. We'll also take a look in the second clip. Check this out, 12 additional stocks and ETFs, including Walmart, XLU, which is the utilities ETF. We'll take a look at the indices in the second clip, and we'll also take a look at our member requests, all right, 4 additional stocks right there. So let's get started here with this first clip. And what I've done is I've actually put the top 2 stocks at the top. I gave them a blue flag, and the reason they get this little blue flag, as you know if you follow this channel, is because they're meeting specific technical criteria that I'm looking for in regards to this indicator. It's called the Ichimoku indicator. It's a Japanese indicator, and all we're really looking for is for price to be above the 9 period, which is the green line, the 26 period, the red line, the Ichimoku cloud, and the Chiku span All right, the Chico span is the current price projected 26 periods ago. We want that white line above the candle 26 periods ago. I also have the directional movement index at a setting of 9 and the ADX at a setting of 9 down here below for a little more additional confirmation. And I'll explain these as we go through these stocks. So NVIDIA, what do I like about it? Here, this is a weekly chart you're looking at. NVIDIA has been in a strong uptrend here, for quite a while, right? It hasn't been under the cloud, folks, since, we're talking about 2023, January 27th of 2023. It's up since that point 1,120%. Okay, big move. Now, this is where it started to move up when it got above, and you can see that big move, and it's been staying above on the weekly. On the daily chart, there's been a little bit more volatility. We've had some pullbacks. We've had just a lot of noise. But right now, in this particular state, NVIDIA is looking actually quite bullish. And the reason I say that is because price is above the Tenkan-sen, the Kijun-sen, the 9, the 26. The cloud itself has turned bullish. The Senko span A, that light colored blue line, is crossed above the Senko span B. And the Chico span, the lagging line here, the current price projected 26 periods ago, is above the candle 26 periods ago. All right, that's the key thing. That's what we're looking for. And the ADX here, that's the that represents momentum essentially. When that momentum is increasing and simultaneously the green line is above the red line, that's actually quite bullish. So we haven't taken out the highs here though yet from May 14th of this year. The highs for NVIDIA were 236.54. We're currently at 225.01. You can see a little double bottom pattern right here. You can see how NVIDIA found support at the 200-day moving average a couple of times and then bounced right off that and broke right through that cloud once again, and now it's off to the races again. So that's what I think, there's a higher probability that the semiconductor stocks are going to do well. It's also reflected in SMH, as I'll show you guys in a few moments. Although it doesn't have a blue flag, it's getting closer and closer to it. SCHW, the Charles Schwab Corporation, financial services sector, very strong chart here on the daily. Even though it was down 0.43%, you can see how price has been steadily moving up. Here's the weekly chart as well. You can see again, price is above the moving averages. The other thing that you also want to make sure is that the green line is above the red line, meaning the 9 period has to be above the 26 period. All right, and there's the lagging line above price. And the cloud itself has turned bullish. You got to look into the future cloud, 26 periods into the future, to see where that is at. I've talked about how that's calculated. You can check out my prior video if you'd like to get more information about the Ichimoku indicator. Apple. All right, now this is the first stock that does not have a blue flag, and that's because there's something technically wrong with it. And I've already previewed all these, by the way. So that's why I was able to identify those two as the top ones. Here's the weekly chart. Okay, 2 weeks now, we're under the 9 period. For Apple, it's still above the cloud. Overall, it's looking pretty good. But on the daily chart, you can see that pullback these last few weeks. All right, so it's holding under the moving averages. We also had a negative crossover here. So I'd hold off on Apple, basically. I wouldn't be buying or adding new positions. You can certainly manage this trade. You can, it certainly would be more of a hold type position if you have a position already in Apple. Of course, everyone can make their decision about when to exit. It's based on your risk tolerance levels. Some have higher than others, right? But the bottom line is that I personally, at this particular moment, I wouldn't be adding positions here in Apple because, as you can see, we've gapped down, we made a little bit of a high here, and then dropped some more, and now we're just kind of holding under the moving averages. And take a look below here, the directional movement index. The red line is above the green line. That's also not bullish, okay? All right, let's skim through these now that you understand all the rules and what I'm looking for in a chart. Hopefully this is going to be a lot easier. We won't have to go through all the details in every single one of these charts, and I'm going to get through these really quickly, okay? Here's Amazon. As you can see, it's currently under the 9 period. Overall, I like the chart on the daily, but let's look at the weekly. The weekly is very bullish too. The only thing, again, it needs to get back above that 9 period, but otherwise I like this chart. DRAM, that's Round Hill Memory ETF, is still inside the cloud. That's also basically when you're in equilibrium, like stock, basically when it reaches and enters the cloud, if it's above it and drops into it, that's generally not bullish, that's bearish because it leads to a pullback. But what's happened in this particular one is that if you notice, there's a trend line there that was broken. Okay, so now it's up. It's basically breaking above this little high here. We've got a higher low here, so we've got like an ascending triangle pattern right there that's been broken, and it's entered the cloud. So it's looking more and more bullish. If you look down below, the directional movement index also confirms that. But the problem is we still have a bearish cloud, and so until all of this starts to really, until price gets above the cloud, I personally wouldn't be adding positions yet. But things are improving. So you certainly don't want to be shorting, okay, betting against it. Google is under the cloud. I'd skip that one, obviously, okay? It's currently in a bearish scenario here on the daily. The Chiku span, remember what I mentioned earlier, how the white line should be above price? It's under, so that's bearish. And so the only positive thing that I see here is that the future cloud is bullish. Tenkan-sen is above Kijun-sen, meaning the green line is above the red line. All right, so I'd skip Google for now. The weekly chart on Google is still kind of, under the 9 period. It's just moving sideways we're talking about like a couple months now. It's just sideways movement here for Google. IGV has recently broken through the cloud, but the future cloud is bearish on the weekly. All right, so again, I wouldn't be adding here. Daily chart, you can see it pulled back and closed under the 9 period, down 2.05. MAGS, which is the MAG 7 ETF, 2 days now under the 9 period. I'd hold off on this particular ETF at this point. Not all the MAG 7 stocks are doing well. Here's Meta, for example. You can see that it's pulling back, dropping further, down 3.5% on the daily chart. It's looking bearish. It's under that 200. I'd skip Meta. Microsoft just today dropped 3.04%. It had a nice little pop up here, gapped above the cloud, above the 200. It moved to approximately, made about a 17% move in just like 11 days, okay? But I'm talking about from the opening price here. But now it's dropping, okay? So profit taking seems to be taking place here. By the way, notice another thing here with the directional movement index. You'll also see a lot of things getting confirmed. Like, for example, the momentum, if the white line is moving up, that means the momentum is still strong. The second you start seeing it move sideways and then starts to drop, as you see here, that tends to lead to a potential pullback. Now, it could be short-lived. It could come down, maybe retest that 26 period and then take off from there. But right now, I would hold off on Microsoft. Let's wait for a better buying opportunity. MTUM, Momentum Factor ETF, is starting to look more and more bullish. The cloud is still bearish, though. Price is still inside the cloud, but we did have a positive crossover here. We've also broken through a trend line. I mean, if you've seen enough of these charts over time, I don't even need to draw these trend lines anymore. I know that a trend line has been broken right there, and now we're basically moving up. Okay, so we broke through this ascending triangle pattern. I'd hold off on MTUM though still, nonetheless, even though it's starting to look more and more bullish down below here with the directional movement index. Okay, MU, guys, let's look at Micron Technology. It's inside the cloud, also showing some strength recently, and it too broke through a trend line. Do you see that trend line right there? Okay, so now it's starting to show a little bit more strength. It broke through this high, it looks like right there, briefly. Let's see, did it? Yeah. And the cloud is still bearish, though. So not everything is perfect, but I'm starting to like Micron more and more. Here's the weekly chart. You can see that it popped above the 9 period this week. We'll know for sure where this candle is, or basically where it closes on Friday. So we still have another 4 days for this candle to materialize. And so we can't really trust it 100% until that actually happens. SMH, same thing. You see what I'm saying? So that's why I'm saying semiconductors are starting to show a lot more strength now, because you can see it's holding above that 9 period on the weekly chart. So these are weekly candles, each one representing a week. And here's the daily chart, a positive crossover. The Chiku span has been moving up steadily. The cloud is still bearish though. Okay, but a trend. So there's a lot of mixed information is what's going on here. As you can see that. Oops, sorry about that. You can see that downward channel has been broken this week. Today, it's like a daily level. Okay. SNDK, that's SanDisk Corporation, re-entered the cloud. That's a bullish sign, but it's inside the cloud, so I'd hold off. All right, still have a bearish cloud here. Tesla is still under the cloud. It's been under the cloud for a while. Look what's happening now. It's basically had a move from this point here, July 29th. It's moved up about 13.7%. But look where it's finding resistance. And there are some reversal type candles that are forming. A doji, a red spinning top, one right after the other. That's not positive, okay? If you guys are unfamiliar with candlesticks, you guys can learn about those. I have a cheat sheet that you can utilize. Go to my X page, all right? I'm under @BlueCloudTrader, and scroll down a little bit. And under, you'd have to go to, oh, did they move things around a little bit? Hold on one second. I had to pause for a second just to check and see what's going on here. It looks to me like the highlights tab has been removed by Twitter, by X.com. Let's see where else it might be. Okay, so I paused again and was able to find the candle pattern reference sheet as well as the chart patterns right next to it. And basically what I've done is I put them at the very, very top. I've pinned them up here so you can find them when you get onto the page. But what I was just talking about was the bearish spinning top. There it is, okay? This is a shooting star. That's another reversal type candle. If you see it after a move up, that's bearish. All right, so here's some patterns that you might want to also check out and memorize. But as far as candlesticks go, this part right here is really important. Check out the middle part of this candle pattern reference sheet. All right, let's get back now. So Tesla, it's holding up above 337.24. That's a level that I'd be watching very closely. It's based on these prior lows here. Let's see, XLE broke through this trend line back on, let's see, that was on August 10th. And since that point, it's actually moved up 4.7%. Energy stocks obviously are, looking the strongest as far as I'm concerned, due to what's going on in the Middle East. And there's a higher likelihood that the oil prices are going to unfortunately go up for us, for gas prices and whatnot, as this continues, this whole ordeal. But yeah, the technicals look really good here on the daily and on the weekly chart. Look at that big candle from last week, and now we're just seeing a continuation to the upside. Financials, XLF, here's the weekly chart, pulling back a little bit, down 0.98%. That's the weekly chart, looks great for financials still, even though it was down a little bit today, 0.98. Here's a daily chart. This was the first day where it closed under the 9 period since July 22nd. So sometimes price will close under, and then the next day it might pull back a little more and then recover right away. So as long as it happened here, and now it's happening again. The question is, will it also break through the 26 period? That's a really, they call that the baseline. All right, the conversion line, the baseline. So we'll see. But overall, I like XLF still. I don't see problems here quite yet, right? And by the way, you look at a trend. We can draw a trend line here from these two little candles. We go straight up. You can see that we're still kind of right on that. We're right on that trend line. So we'll see if we can hold up. All right, let's keep going, guys. Now, I'm going to show you guys the second clip from CNBC, the halftime report, and then right after that, you'll see Josh Brown on Closing Bell, and then I'll do more technical analysis in the last segment. And so stay tuned for that.
All right, welcome back. Let's talk Walmart. Reiterated buy today, 150 is the target at D.A. Davidson. Company reports earnings on Thursday. There's the name. Let's get a little bit wider chart if we could, gang. Please see what the stock's done year to date. If you could show me that, please. You can see 3 months down 12-something% year to date, eked out 3%.
Off what was last quarter a really solid print. It was a good earnings report. I think investors became troubled when management spoke about the effects of inflation. I don't think that language is going away in this report. I think they're going to talk about the effects of inflation once again. I also think valuation got the best of both Walmart and Costco. It reached into the mid-50s. It's pulled back now maybe not enough. What would I like to see as an owner of Walmart? I'd like to see them deliver on e-commerce growth somewhere near 30%. I'd like to see them deliver on advertising growth near 40%. That'll make me comfortable that the business is still in good condition. Now, while some will move to the sidelines, we'll maintain positioning, and I think it's a pause that ultimately refreshes. I don't know if you're going to get the refresh that is sustainable beyond this earnings report. I think you maybe get a reflex bounce back up into the mid-120s. Be careful with that because you still have the inflation language lingering and the valuation argument.
Guys, if you can, in the control room, if you can give me a Target versus Walmart year to date. Because it's been a Target story.
Yeah, I mean, Target, what's Target up? 55% so far?
57.
Okay. So it's been
But there's a lot of questions as to whether that bounce back is simply a bounce that's not sustainable. But it had to bounce off a bottom of somewhere, whereas the outperformance, I think, if you were to look at this from a much longer drawback, would be no comparison. Walmart blowing past Target in terms of share performance.
Yeah.
And now it looks exactly the opposite. I mean, part of it is there was kind of only one way for Target to go.
Right.
But they report earnings this week, too, by the way, on Wednesday.
Yeah,
with TJX, which you own.
I think Target's down 37% in the last 5 years. Walmart's up triple digits. I think it was an idiosyncratic recovery related to Target that maybe the business was not going to implode, which was what the anticipation ultimately was. You mentioned TJX. That has been another really good position for us. You've seen strong revenue growth up at around 7%. And again, the thing to remember with Walmart, with Costco, with TJX, not Target, is market share capture. Market share capture in an environment with higher oil prices and higher inflationary pressures, they have the ability, being big box retailers, to have that scale.
No, Costco hasn't traded well either, by the way.
Well, Costco's
because of the valuation standpoint, right?
Valuation, trading in the same possible way. So I like TJX, I like Ross Stores, I like both of those because of the off-price nature. I think Walmart and Costco long-term, I own Costco personally, I think you're fine there. I'm just arguing that in the near term, you have this valuation obstacle in front of you, and you have management which is absolutely going to cite inflationary challenges.
Give me Regeneron, guys, real quick, please. Where's that stock trading
They're
today?
a 52-week high.
So at 810, so Leerink had it before at 641 was their target. They're now coming up to this universe in terms of price acceleration. 824 is their new target. What do you think about that one?
So this is a company that has the ability to really rebuild. If you pull the lens back over the last 5 years, Scott, you're going to see in August of 24, the stock was somewhere around $1,200. The stock fell precipitously. The eye care business ran into some challenges. Offsetting that more recently is the collaboration they have with Sanofi. That's been a positive catalyst. That's kind of restarting the interest in owning this name once again, and the momentum which presented itself 2 quarters ago, and that's the reason why we took ownership of it.
Many of these traditional biopharmaceutical companies that are more pharmaceutical now have had the similar trajectory. So it's true with Amgen, it's true with Vertex. And my point on this is all 3 of those companies are now rallying strongly. They have decent valuations, they've got good pipelines, they've got good science behind them. I think this is a space to be. Vertex is my selection.
And by the way, Regeneron, don't hear Regeneron and think extreme valuation.
No,
this is a
that's my point.
Valuation for this company.
Yeah.
Is that what people normally do?
I think a lot of people, when they think of exposure to biotech, they think of the extreme valuation. But to Jimmy's point, in the case of names like Amgen and Regeneron, that's not the case. It's reasonable valuation.
Franco, Micron, Western Dig, Seagate.
Here we go.
Momentum.
The love affair begins once again. Look, I think one of the catalysts was the CapEx for sure. And we talked about when the Mag 7 reported the derivative effect was going to be in-memory and AI data center build-out names if the CapEx was there. And I think that's what you have. You also have a market where, look, it's August. It's a quieter market. That doesn't mean that the HFTs and active traders are not participating. They are, and they're gravitating towards where they could find the volatility. And the volatility right now is very isolated, and it's isolated in these names.
Jimmy?
Well, Joe and I own Micron, and free cash flow at Micron next year is going to be about $130 billion. A couple of years ago, it was around $20 billion, and that's what's moving the stock. Once you get past the deleveraging that happened in July into early August, situational awareness, the Kospi, all of that stuff, now we're focused on fundamentals. Tremendous cash flow. They're going to be buying back shares. 6 times earnings. Yeah.
Yeah, I mean, Adam Parker's talked about this stock doubling from here. Weiss?
Yeah, it's finally above where I sold it, Micron. And it does have legs. I didn't think it would be the top where I sold it. But I have no regrets. I put the money elsewhere and I'm doing well. So that's how I look at it.
Okay.
Maybe you should get back in.
He did it his way. No regrets.
Nothing's out of the question, Joe. Nothing's out of the question. I'll look at my Terra Nova momentum factor and make a decision.
I like that.
All right. Regrets?
I guess he's had a few. Yeah, I kind of, mashed it up there.
Regrets are
don't ruin it.
justification. You can call it what you want.
Jimmy, don't do Sinatra.
We'll do finals next. All right, 3 o'clock Eastern today on the closing bell. Josh Brown will be with me. Chris Heisey, Mark Okada, Shonali Bassick, and Megan Shu. And I hope you'll join me as well. We'll track this market right into the finish. Steve Weiss, what's your final trade?
Cisco, I bought it last week, and I like to set it right here, right now. I think it's going to move higher.
Wow. All right. Jimmy, you have that?
I do. I like Cisco here. I applauded Steve
You
for
like
that
the
last
move?
week.
Yeah.
I do. Very much so. Bought it on the dip. It had a post-earnings breakdown. He bought it, picked it up on the cheap. Good job. Cheniere Energy, for me, I'm violating Josh Brown's rule of never having a final trade that's in the red. But dips are to be bought in this name.
Okay. And then the IDU, which is red today, is who?
Utilities, that's me. Broad data center growth, Scott, and self-funding balance sheets in the utility sector. So get excited.
No chance that's going to be me.
All right,
But I'll take Merck.
How about Merck? Why?
I have Merck breaking out above its June 2024 high. I think this is a $150 stock.
All right, great stuff. I'll see everybody for the closing bell. All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with the record run for the bulls and the sky-high level some say stocks are poised now to reach. We'll discuss with our experts if that's possible over that final stretch. Here's the scorecard with 60 to go. In regulation, we're mostly red, as you know. Chips, though, a standout. Nice gains today from Micron, SK Hynix, and Marvell. There you go. NVIDIA is also green about a week before it reports earnings. Had a really nice run lately. Otherwise, industrials and energy have been the bright spots in an otherwise red tape today. It does take us to our talk of the tape. It's 3 weeks and counting for the S&P's winning streak. So how long can this momentum last? Let's welcome in our headliner today, CNBC contributor Josh Brown. He's the CEO of Ritholtz Wealth. It's good to have you here for a rare appearance on Closing Bell.
I know. Well, when the market calls, I answer.
I
don't know
guess so. And the markets are calling. Like I said, 3 straight weeks. VIX is on Friday it was the lowest it's been all year. Yardeni says 10,000 by the end of the decade's possible. Evercore today says 9,000's possible in the next 12 months. Yeah. I mean, that gives you the kind of optimism that is being exuded really everywhere, it feels.
Yeah, and, the negatives are very well cited by now. Everyone understands that people are bullish, and I know there's this sort of knee-jerk thing where, well, if everyone's bullish, I better be on the other side. That really only works at major turning points. For the most part, you want the safety in numbers, and you want to be part of these record-setting bull markets, because if you're not, you can't catch up. The returns come from markets like these. We have long periods of time where the market does nothing. You have to stick around for the moments like these. You can't all of a sudden get bullish because the market runs up 20%. So the big picture here is, if you knew nothing about what the market did this year, but I just told you 84% of S&P names have reported so far, and profits are going to grow 32.2% year over year. And I said, what would you say the market should do? You would say it should be acting pretty much exactly the way it's acting right now.
Okay, then put on top of your Sunday that you're scooping out gross margins, right? Those numbers are amazing. The revenues that we're seeing are amazing. So there are a lot of different things that look and taste pretty good in this market.
So when you talk to the people that have been bearish for most of the last 16, 17 years, the thing that they've repeatedly said was that earnings would mean revert because profit margins would be unsustainable at 10 or 11%. And here we are at 15. So we still haven't had the revert. We're still waiting for that reversion. In the era that we're in, the way that earnings are growing, it's coming from a very specific source. It's coming from technology. And very hard to predict when the cycle ends. We know it ultimately ends. But there have been people that have been waiting year after year after year, and it just doesn't seem to be happening.
Let me ask you this. So look at what we're seeing now, okay? We're looking at the yield curve, basically, right, on your screen. And the bottom, 531 on the 30-year.
Yeah.
At 520, when Fed Chair Warsh was giving his last news conference in what was a decidedly more hawkish event, the market started selling off as the 30-year hit 520. We're like, wow, look at that. That's a much more hawkish take on the Fed. And here we are, as we say, at 531. Jonathan Krinsky has a note out today, said equity market's not prepared for 6%. Now, I don't know if we're going to 6%, but the point of bringing it up is to ask you, at what point is that an issue?
So it could be a temporary issue, but I think it would end up being met with buying. And I spent an afternoon 2 weeks ago with Ed Yardeni, and Ed Yardeni coined the term, literally invented it, bond vigilantes. He doesn't seem to be terribly worried about that this year. His year-end target for the S&P 500 is 8,000. If Ed's not worried about bond vigilantes, I'm not overly worried. I do agree, though, that there would be some new volatility coming into the market if people all of a sudden get spooked. But as always with these things, it's more about the rate of acceleration than the actual level itself. I'd also point out the 1990s, one of the best decades for stocks of all time. The average interest rate on the 10-year was 5%. Like we can live through it because we have before.
Well, but you're saying what you said is right, though. It's not the level; it's the speed in which you go from one level to the other.
Of course, you don't want to see something in the bond market that shocks people, but to just talk about an absolute level in the absence of the causal, the reasons why we're at that level is, I don't think, helpful for investors.
So speaking of levels, as long as earnings remain at these levels, which are knock your socks off amazing. Everybody can agree with that. And it's no longer just a tech story. It's broadened substantially if you look at the percentage of beats and what have you. So as long as we remain delivering these earnings, why should the market do anything but what it's doing?
It's funny. A lot of people were complaining about the nature of the earnings growth in the 20-teens decade because they said, oh, it's engineered, it's buybacks, it's buybacks, it's buybacks. That's not part of the story this year. Not only is it not buybacks, but companies are actually going into debt to do even more CapEx spending. If you had rewound the clock and told the buyback truthers, hey, we're going to have another bull market that'll look just as good as this one, but instead of companies shrinking their float, we're actually going to see them go out and borrow money or issue secondary shares of stock and invest directly back into the economy. Will you be bullish then? They would all say yes, and none of them are bullish now.
So when you look at your menu, and you know where I'm going here, of the kind of stocks you want to have, you pick what you say is a porterhouse. It's a strategy that you have at your firm. You talk about it a lot on Halftime. I don't want to take for granted that people who are watching this now know what that is. So what kinds of stocks work and make sense in this kind of environment? What is that?
So our original research into the best stocks in the market, the premise was we want to stay on the right side of trends. We want to have a way where we can own the market leaders, but have there be a built-in risk management function so that when leadership changes or there are whipsaws or a trend just literally comes to an end and a new trend takes over, we're not sitting with yesterday's leaders hoping for them to come back. We have that game plan, and it's quantitative and it's rules-based. And we took that idea and built the porterhouse strategy, which right now has 50 stocks in it. It's very concentrated. But the goal is to be in the SanDisks, be in the Microns and the Western Digitals and the KLAs, but not be in them naked, not be in them with no answer for when we sell. By the same token, we also don't want to have extraordinarily high turnover because, remember, we're a wealth management firm, and taxes are a really big part of the net returns that investors receive. And it does no good to be whipsawed every week or every day or reacting to intraday noise.
So you're not afraid to play in the momentum sandbox, obviously, if you have the kinds of stocks that you just said, but you're trying to offset it with things that are not going to be potentially as volatile as those could be, frankly, at any moment, which is one of the characteristics of this market that we've been in. Those kinds of stocks in that kind of factor have, had a significant reset at points, and this market has been resilient through it.
Yeah, because when you have a stock that goes up 800%, it could be in a 30% drawdown and still statistically be in an uptrend. This is like one of the hardest things to do if you're just sitting there manually trying to select, when do I buy SanDisk? When do I sell it? When do I buy it back? So having rules in advance doesn't mean you won't lose, or you won't be wrong, or you won't be early, you won't be late. But it takes a lot of that sort of, guesswork and inconsistency out of the picture. And SanDisk is a really great example. It's had massive drawdowns this year, and yet it's been on our list of the best stocks in the market since last year, has never come off because that longer-term picture, not just technicals, but the growth rate, et cetera, has been intact. So we traded 10 days ago, so I could talk about this publicly. In the Porterhouse portfolio over the last month, we sold out of Vertiv. We sold out of BWX Technologies. People that are in momentum trades or people that are playing the AI CapEx story, they know these tickers very well. The long-term trend had weakened. Short-term price action broke. They're out of the portfolio. It's not a judgment are these good companies or not. That's not the goal here. The goal was to make money. Regions Financial was a sale. Ford was a sale. These had been great stocks up until recently. What did we buy? Rockwell Automation, which obviously the robotics and automation theme. Ovintiv, East West Bancorp, Citizens Financial. So that's an industrial, an oil company, and two financials. So it's not just about AI CapEx. It's not just about tech. The portfolio will own stocks in every sector. And the reason that's so important in a tape like right now, 11 out of 11 sectors have beaten beginning of season growth estimates through the period that we're at in the quarter. 10 of 11 sectors are posting a year-over-year increase in profits. There's money being made away from AI. How do you find those stocks? How do you end up in those stocks before your friends and neighbors are talking about them at the barbecue? This is the goal. This is what we're working on specifically with that Porterhouse sleeve and client portfolios.
It's apropos that we have spent some time talking about, the portfolio, but also in general, the fact that chips are having a pretty decent day, at least memory names are. Oliver Rennick is at SIBO in Chicago. He's tracking the options activity, which is pretty substantial, isn't it, today?
It's massive, Scott. In fact, it's been one of the most wild days for semiconductor options tradings we've seen in a while. Volumes are exploding again in favorites from the first half of the year. SanDisk, Micron, all seeing massive call option volumes to the point that upside calls and some expiries are multiples more expensive than the equivalent puts to the downside. DRAM, the ETF, is doing twice its average 30-day volume, and the ratio of calls to puts in SMH is the most bullish since April. Might sound familiar, but the single biggest trade in the entire market today is a gargantuan $130 million purchase of in-the-money 630 strike puts in the SMH. It's a synthetic short expiring in November. For perspective, that's more than a third of the entire ETF premium today in a single trade, which is almost 4 times bigger than the next biggest trade in the market. So basically for investors, the question here is, who do you go with? The crowd, where flows have been getting more bullish since the situational awareness blow-up, or this specific single contrarian, a giant whale, putting on, I think, what is the biggest trade I've seen in the fund all summer.
That's a great look, Oliver. Thank you so much. That's Oliver Rennick. Okay, let's bring in our panel now. Merrill and Bank of America's Chris Heisey and iCapital's Sonali Basak. Josh Brown, of course, is still with us. Guys, it's great to have you here. It's funny that Oliver mentions, what do you do? Do you, sort of ride with the crowd? Chris, there's a big crowd of bulls. Is it too big?
There's a big crowd of bulls until something hits the tape that they don't like, and they kind of walk it back a little bit. Josh hit it on before. There's been something on everyone's list every year, and we've been doing this a long time, and it seemed like the list was smaller decades ago. Now it doesn't matter what it is. It just comes in there. And the bear camp never points to the denominator. The denominator is promo, profit momentum. And that's what the crowd is following. And until that story and that narrative changes, it's going to be very hard to be a contrarian. And Some people like to be a contrarian just to be a contrarian. And they find little bits and pieces to fit that story rather than focusing on what is visible, what is working. And again, you mentioned the 5% 30-year yield.
Mm-hmm.
What happens when we hit the 6? They said the same thing before we hit 5. Stocks are not going to like 5. Stocks are not going to like 4. And Josh talked about the average 10-year yield being around 5% during the 90s. And the yield curve was pretty good steepness there. And now we survived going from 0% front-end rates to 5 to 3 3/4, and yet there's still a complaint out there about, oh my goodness.
You know who likes 5? The $9 trillion sitting in money market funds and deposit accounts.
Right.
The boomers really like 5, taking no risk, earning 2 to 3 points above the rate of inflation. I think 5 is not the negative that it once was because of how much cash there is in the system. Perversely, we actually saw rising rates generate more spending on things like travel and second homes because that people have cash in an account they expect no return on because for 15 years rates were 0. Mm-hmm. All of a sudden that became a geyser of new cash.
That's right.
They actually don't know where to put it.
Yeah.
So this idea that 5% was going to break the market, I knew it wasn't going to be true.
I mean, the most boring thing in the world is to say that if you put your money in a high-yield savings account at the beginning of the year, you're actually doing a very good job this year. But, you know, that is, to your point, money in the bank. Where it doesn't do well, though, is for highly levered companies, and I don't mean the AI borrowers. I mean the host of companies that have been extending and pretending. So I think that the flock to quality here makes sense, and it's part of the reason you're seeing the broadening.
You know, there was a note out today. I forgot who it was by. It's not that important, but the note itself, the crux of it was it's hard to be a bear, sort of to these guys' point. It's hard to be a bear, but can we really continue to live up to these, you know, immaculate markets and expectations and earnings? Something's got to give.
Risk management.
Or not.
Josh
Maybe
said it a
doesn't.
little earlier. If you're managing your risk appropriately, then you can sleep at night while you're appreciating the upside here. Chasing momentum is a full man sport, in my own opinion. For us, we have a lot of people employing buffered strategies for this reason. You know, structured investments that'll cap downside risk here. But again, it lets you stay invested. Scott, let's not forget how many people missed the last 3 years. A tremendous amount of people in the market, so nobody wants to miss the next leg. But at the same time, I would agree with Josh that there's other places to look besides where just the herd is going. So if you can just take out your pencil and do the math, there are some places in the market that still look cheap.
Is the next leg driven by the FOMO that Shanali's talking about? Maybe part of it's already here. Ed Yardeni calls it FEMO.
Yeah.
Instead of FOMO, it's the earnings momentum that's driving the whole thing.
There are no signs that earnings momentum is going to shift from a slower growth rate to a substantially lower growth rate between now and mid-27. We can't think too far out after that because so many things can come into place. But we were talking about this before real quick. When are international stocks going to outperform? They have been. When is value going to outperform growth? It has. When is small caps going to outperform large? Remember all those types of arguments?
They have.
And they have. So
Russell's up 23%.
Yeah.
Almost a double.
But to your point, you never hear people come back and say, yes, this is the thing I used to complain about. It's been cured by the market. I'm now bullish. They just move on to a new thing to complain about. So the people in 2024 who said it's all Mag 7, it's all AI, it's all hyperscalers, those are the only stocks going up, it's too concentrated historically, when the S&P concentrates above 30% for the top 10, all the blah, 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 blah. That's over now. Those are not the leading stocks in the market. What's replaced it? Healthcare stocks, industrials, energy stocks are leading this year. We have utilities that are up double digits. We have retailers that are working. I don't know how, but it's true.
Forget the Russell. What about the S&P mid-cap?
Right. So, but do these people come back and say, remember all that concentration I was scaring the hell out of you about, 40% lower? Well, it's not concentrated anymore. I'm bullish. It'll never happen. You know what they're talking about instead? Yen carry trade. Right. What color tie did Kevin Warsh wear? They will not come back and say that thing I told you was bad. Now it's fixed. Okay, I'm happy with it.
Are you a believer in the continued broadening story?
in the market?
Absolutely. And you look around and there's still more room to run. The outperformance is recent, which means that, even in the last month, the S&P equal weight still did not outperform the NASDAQ or the SOX, which tells me that it's still been relatively left behind, even in recent days.
I still think back to the John Waldron comments of a couple weeks ago now to Andrew. I believe it was out in Aspen where he talked about the broadening of the earnings growth.
Yep.
That now it's, you look average by sector, it's like more than 14%. So it's a broadening earnings story, thus it's a broadening market performer.
Right.
And until that changes, and maybe it even gets even better as some of these, beneficiaries from AI show even greater earnings growth because of all the benefits that they're now getting.
That's right. That's right. The argument was, well, there's only a few that are going to benefit from the revenue side, and we're betting on all these people having an ROI on what's all been spent. You cannot measure productivity today the way we used to measure productivity. You measure it in margins, and if margins stay wide, it's doing its trick. My last point here, I'll say this: when you look at the broadening out and everything. The story was small caps had bad earnings before, negative earnings. Now all of a sudden you go from negative to positive, that second derivative. That's a big deal. Same thing in emerging markets. They're big oil importers. They're still doing well. Fiscal deficits are everywhere in the world. You could look at it as a negative, or you could say that's what produces 6, 7, 8% nominal growth, which feeds the revenue line. And that's why you have the broadening out.
All right, we'll leave it there. That was great. It's good to have you guys here on set. Thanks for being here. You stick around, okay? We're going to take a break. You're not going anywhere. Don't leave. All right, coming up next. How do you view both of these companies, this race to go public, what brain drain, some of the departures, the difference between the way these two companies are perceived?
So I said last week, we've never had trillion-dollar startups before, and as a result, the level of scrutiny that these companies are getting prior to going public is something brand new. Dario is currently attending the Sam Altman School of Public Relations. Doesn't appear that he's having a lot of fun. Sam went through this last year. Dario's turn is this year. These guys, their messaging is not ready for prime time. It's sort of okay. We like a little bit of eccentricity in our tech geniuses. It's also sort of crazy. Here you have a guy last year starts going on podcasts and making public statements like, for example, 50% of all white-collar jobs will disappear. And then everybody should fund this thing that I'm building that's going to bring that about. So he stopped doing that. Now the debate has shifted. Gavin Baker and others are talking about, let me get this straight. Your pitch is that AI should be heavily regulated, but we know what happens when you do that. It creates regulatory capture and monopolies. Famously, people used to worry about Facebook because there'd be more regulation. I would come on the air and say, no, you don't understand. The more regulation, the better, because now no one can afford the compliance costs except for Meta. And as a result, you won't see any new social networks. And that's exactly how it played out. So is Anthropic pursuing this sort of public policy push where they say open weight models, open source models are too dangerous? There should be a vetting process anytime a new model comes along, and then people will look at that and say, yeah, we get what you're doing. You're trying to capture the whole industry and stop startups from coming out with their own products because all the profits are in big companies paying you for access to Claude. So that's the debate right now. I think for investors, it's probably not important. I think what investors should be focusing on is the news that we got today, a 14-fold increase in second quarter revenue over last year. Positive net operating income.
For Anthropic.
Right, $11.5 billion in quarterly revenue. And anecdotally, our event Future Proof is next month out in Huntington Beach, California. Anthropic is coming. They have an amazing guy running their asset and wealth management business. His name is Peter Nolan. They'll be making announcements with lots of companies there. So I don't even know who his counterpart is at OpenAI.
Okay, so
Nobody does.
So what does that tell you about what they want their reach to be and where they see the multifacets of their bigger business going?
Okay, the multifacets of their bigger business are going in one direction, upstream. This is uncomfortable for incumbents, but they will be making and selling software. They are not going to be a company that lives and dies based on having a model that is 1% faster than someone else's model. That's not actually a business. The actual business will be figuring out the profitability between compute and selling an enterprise product. Not everybody's going to like that. Alex Karp kind of rang the alarm about this on Squawk the other day, but that is 100% what will happen. And it has to happen, because if you're just in the business of selling tokens, tokens are in mass deflation, and it's really the profitability will accrue to the companies that figure out what will enterprises pay for those tokens, not just who will they buy the tokens from. So the compute side of the business is going to be a little bit more industrial. The thing that Anthropic's going to do, and I think they'll do it really well, is they're going to find ways to take the power of their model, productize them, and sell them to companies. And again, that will not be popular in Silicon Valley amongst the incumbent software companies, but it's almost inevitable that this is where things are going to go.
That was awesome, and that was a treat for us. Really
and
good having you
OpenAI
here.
needs to figure it out too, which will be the next.
Yeah.
That's the next battleground will be product, not compute, not tokens, not LLM efficiency. It's going to be what will people buy.
Don't be a stranger on this show, okay?
I love this show.
Good
It's
show.
my favorite show.
Good having you.
Thank you, Judge.
All right, that's Josh Brown.
All right, so from those clips that we just saw, let's take a look at some more stocks and ETFs. There's 12 right here, and the top 4 start off with Amgen, healthcare sector, right? It's in the drug manufacturers, major drug manufacturers. Here's the weekly chart, very bullish. Broke through this 391.29 level about 3 weeks ago. Everything was looking very bullish as far as the indicator, the Ichimoku indicator, right? And it's looking good on the weekly. It's still looking good on the daily chart. It passes the test. Certainly a stock that I would consider adding to my portfolio. Merck also looks great here. Weekly chart and daily chart, very bullish. REGN, Regeneron Pharm Inc. It's in the biotech industry, healthcare. You can see here on the daily chart looking very strong, up 0.3% today. And on the weekly chart as well, it actually is holding up right above that 200-day moving average. There is some resistance that it appears to be finding, though. Let me just go ahead and throw that trend line right there. So there's the high, 821.11. We're going to color that light blue to represent the weekly time frame. I typically color weekly levels blue and daily levels red, so it's easier to identify. What I like about this chart is the fact that we have a higher low here on the weekly from this low, so we've got a nice uptrend going on, and we just need to break that 821.11 in my opinion. Once we get above this prior high here, that's going to be very bullish for REGN. Here's a daily chart. Notice how price has been kind of slowing down here and just kind of moving sideways. So we'll see what can happen. Same thing with the momentum down below, the directional movement index. Like I mentioned earlier, the momentum is strong, but then when it comes close to a level of resistance, a prior high, like the one I showed you, price can sometimes take a little breather, and collect itself before it decides whether or not it's going to continue to the upside, or will it break through and, the bears start taking control. That's what we're going to wait and see. But right now, I wouldn't be adding position here because of its how close it is to the 821.11. It's literally just about 2% away. That's not a really good target. XLV, healthcare, looks good. It's pulled back and created a nice little bullish spinning top after the pullback. So when we see one of these types of candles after a pullback, that's very bullish. Daily chart, and here's the weekly chart. Granted, it did still close down 0.19%, but I'm overall more bullish than I am bearish with XLV. The rest of these did not get a blue flag, meaning there's something technically wrong. Let's take a look at Cisco. Yeah, it's entered a gap down back on, what day was that? Thursday last week, August 13th, and it's still inside the cloud. I would hold off on Cisco, obviously. EEM is the emerging markets ETF. That one came up to this 68.15 level. It goes back to this date here, May 11th, that prior high. And it's interesting how it came close and then created a gravestone doji. That's what they call that specific candle right there. Let me see if I can find it. That's right here. Do you see this pattern? It's basically when you see, let me go ahead and draw it on here. a wick and a flat body at the bottom. If you see a flat body, what that represents is that the opening price and closing price basically are the same level. Okay. With the understanding candles here, the opening price on the green candle is down here, the body of the candle, that's the opening price at 9:30, and over here it's at 4 p.m. That is the closing price. The wick represents how high price moves throughout the day, the upper wick, and the lower wick represents how low price went. Okay, and so if it's a green candle, obviously the opening was here, and this was the closing. If it's a red candle, the opening is at the top, and then it closed down here. But it's the wicks still represent the low of the day and the high of the day. All right, quick little mini lesson there on candlesticks. You know, there's a lot of people here that are never even heard of Japanese candlesticks. I get it. You know, there was a time I didn't know anything about it, but let me say this: they are a visual representation of what's happening behind the scenes between the bulls and the bears. You know, the basically the buyers and the sellers. So there's a battle taking place every single day, and someone wins. And price is either going to move up or it's going to move down, and we can see it visually. We can also see the prior days where the history of price movement. You know, and you can do the same thing here on the weekly chart. That represents the, you know, if you're looking at a weekly chart, you know, 9:30 Monday, 4 p.m. Friday. Okay, does that make sense? Over here in this red one, 9:30 on a Monday. Here on a Friday, it closed down. So that was a bad week, obviously. And then we've got patterns that can form, like the bearish engulfing pattern here that led to this decline. That's when you, for example, see, you know, this like small little bullish candle followed by a large red candle that engulfs it, right? And then price, you know, there's a higher probability that price is going to pull back when an event like that happens, because basically what happened in this scenario is price moved up, it gapped up, in fact, but then the bears took control and pushed the price down. Okay, and then the next day the same thing, it drops some more, and then it moves sideways, drops some more, and then of course this is where the Ichimoku indicator comes into play, because we can observe how price is reacting to the actual moving averages, like the 26. Notice how it's just sitting. It keeps on closing above the red line. That's a bullish signal. When you also see a long wick at the bottom of a candle, that's also bullish. That represents a lot of buying that took place that week, and then it just continued to the upside. Now, right now, on the weekly chart, we only have Monday, so this candle is there's not a whole lot of data. So Friday, you'll have a better understanding of where we're at with EEM, but I would certainly wait a little bit longer, obviously, on this one. There's the weekly chart, and there's a daily chart. You can see the cloud is still bearish. It's basically telling you, you know, it's not all elements of the Ichimoku are perfect. If you're looking for perfection, if you're looking for all the elements to be in the correct order on both the weekly and the daily time frame, it's the top four. Higher probability trades, basically. All right, let's look at Ford. Ford is under the cloud. Skip that one. Okay, I wouldn't be interested in that. IDU. This is the Utility Sector Index Fund ETF. It's under the cloud. No on that one. ROST. No on Ross Stores Inc. It's apparel stores. Look at it, declining down 4.11%. Everything started to go bad when price got under the 9 period right there. Okay, if you look over here, the red line crossed above the green line. That was also another negative signal. So that's not good. But it's pulling back. Let's look at the weekly on this one. Still holding up. So there's a higher likelihood now that we're getting closer and closer to the 9 period on the weekly chart, that maybe price will stall and create another new leg to the upside potentially. But while it's in the process of declining, I wouldn't be adding positions. I want to wait for something like this to happen right here, where price starts to reverse, moves up, breaks above the 9 period. Now we've got another new leg up, just like we did over here, just like we did over here. Look at that nice move right there, where price got under the 9 period, and then from that point to that point, it moved up 42.8. Wow. Hold on, sorry. Let me measure that. To that closing price, it moved up 42.8%. in approximately 6.9 months. Then we had a bullish engulfing pattern. It continued to move up. But my point is, it can help you to sort of identify places to exit positions, and you can make, listen. There's so many different ways to trade the Ichimoku. As far as some people like to add a position when there's the moving averages are crossing, above each other, like the green line crossing above the red line, and they may not even take into account whether price is under the cloud or inside the cloud, or there's different ways to trade it. I look for the optimal way. I found that using the traditional method seems to work best, at least for me. Here's TJX. Right now it's kind of stagnant. It's basically in a consolidation stage where it's moving sideways. I'd hold off on TJX. It's also under the moving averages. That's the weekly chart. Here's the daily chart under the cloud. Here's Walmart inside the cloud, showing a little bit of strength recently. But it's still under the 200. It's still inside the cloud. I'd hold off on that. Utilities XLU, also under the cloud. No on that one. All right, let's take a look at the indices next, because this can help give us some introspection and guidance into the entire markets, right? So the QQQ ETF, for example, broke recently above this trend line, remember, on Thursday last week, August 13th, and it's holding up above it, even though it's down 0.16%. I like QQQ right now. It still has a blue flag. Looks good on the daily and on the weekly chart, still holding up. Russell 2000, which is IWM, on the weekly chart looks good. Above 302.72 on the daily chart, also above that level. I like IWM ticker symbol. Okay, I like FEZ, the Euro Stocks 50. Want to have some exposure to Europe? This one is still looking good. It's been sort of slowing down a little bit right here, but the ADX is still showing momentum is increasing. It's not moving sideways yet, which is good. That's a good sign. Let's take a look at the weekly. Yeah, I like the momentum here. Even though it's down 0.26%, it's not a big deal. S&P 500, the SPY. Here it is on the weekly chart, holding up. I like the weekly chart. Nothing negative to say on the weekly, but on the daily chart today, price actually closed under the 9 period. What does that mean? It means that, and so it lost its blue flag from last week where it was above. There seems to be a higher favorability for the smaller mid cap, like the Russell 2000 and the technology stocks, which is a lot of technology stocks in the QQQ. And same thing with FEZ, the Euro stocks. So the SPY and the Dow, which represents large cap companies, they're not doing as good, right? You can see the difference in the percentage drops here too. And let's look at the Dow Jones, DIA. The Dow has been under the 9 period for a couple of days now. But on the weekly chart, overall, still holding up. It's not like they're breaking down significantly. There's not like a huge, decline happening here. We're still in a nice, strong uptrend overall. The VIX was up 6.46%. Probably fears of what's going on in the Strait of Hormuz, I'm guessing. And as a result, gold was also up 1% today. So here's a weekly chart. You can see the last 3 weeks, gold has been moving up steadily. Remember, this is a falling wedge, and this is actually a bullish pattern, guys, a falling wedge. Let me show you this pattern right here on that cheat sheet that I showed you earlier. So once you're on this page, make sure you'll see a little arrow here. Click on that. Whoop. And as you can see, with the sound effect, it basically pops up these patterns. Now, where is that falling wedge? It's right up here in the top corner. Falling wedge. Bullish. Bullish. It's when we have price. And it typically, you would think this is a bearish pattern because price is creating lower highs, right, and lower lows, but they're very, very, the way to look at it is if it's a very tight, consolidated drop like that, and price breaks through, and then comes down and then retests that trend line and continues up, that's even more positive, and so that's the bullish variant. On the bearish variant, you can see it here, okay? It's basically making higher highs, higher lows in a tight consolidated triangle, but then it breaks under. And so that is something to keep in mind. So that's what we've had here. See that tight little consolidation? It's not consolidation. It's a tight pullback. All right, and now it's breaking through. Look at that candle, that breakout candle. I like that breakout candle. So my intuition is telling me, and this just many years of trading is telling me like, okay, gold is probably going to start taking off soon. It's still inside the cloud. Chico Spin is still underpriced. I personally have positions in certain gold stocks, and right now they're doing quite well. So if you guys want to learn more about the positions that I have in my portfolio, you can become a member. So there's two different ways to support this channel. Let me just tell you real quick. If you go to my channel here, Blue Cloud Trading, there's two ways. One, you can subscribe. It's free. Free to hit that subscribe button and notification bell so that you know when I'm putting out a new video. This is time sensitive. I would recommend that you hit that notification bell. Secondly, okay, click the join button. Now, under this one, yes, there is a cost. Right now, there's actually a promotion here, 100% off for the Blue Cloud supporter. Under this level, you can request a stock or ETF be analyzed on an upcoming video. All right. Under Blue Cloud Trader, this is where you get access to the member-only videos that I do each weekend. They're usually about an hour long. I go over my entire portfolio. Okay. So you can see the trades that I placed throughout the week. Added the stocks I closed out of. I do a quick summary of everything, and then I also provide new stock ideas for the upcoming week based on the strongest sectors and industries. So I do a top-down approach, and then if you want even more, Blue Cloud Legend. Maybe you want to get updates on my trades daily. Like today, for example, I posted, my trades. Okay, Blue Cloud Legend. Right, and once you become a Blue Cloud Legend level member, all you need to do is just go to the Posts tab, click on that, and that's where you'll find my daily posts. All right. Alrighty, let's get back. Let's get back to the charts. So GLD I like, SLV. I mean, when I say I like what's happening here with this pattern. I like the fact that it's moving up. It's your decision. Would I be adding this particular ETF? No. To my portfolio, not at this point because it's still inside the cloud, and I do like to adhere to my rules for entry. So, but I would say that there's a higher probability it's going to move up, and you could certainly start looking at stocks that are within GLD, right? And if you're using TC2000, by the way, there's also a link for this with a $25 coupon. It will be in the description section. If you like the software that I'm using here. Look, let's say that I type in GLD and this pops up, and I want to see what stocks are within GLD. There's a little thing right here, right to the side, component watch list. Actually, that one did not show up. But, okay, for whatever reason, I'm not sure why that didn't. But SPY, for example, if I click on the SPY and it pops up, there's the 500 plus stocks in there that show up when you click on the component watch list. But you can just also look up gold stocks under the there's a thing called the drill down segment section where you can go look for a sector, the industry within it. Under basic materials, you can find it there. All right, so we talked about gold. Silver is still, under this 60.37 level, but it was up 1.86%. Okay, it's still under the cloud, but it's starting to, it seems to have found a floor here. And then Bitcoin, IBIT, ETF, also looking okay, I suppose, because it's holding up above this 35.30, but it's under the cloud, under the 26 period, and the Chico Spin is underpriced. I would hold off on Bitcoin. All right, it was up 2.22%. Let's look at the daily chart. You can see it's entered the cloud. That's always a good thing when it's, when price is under the cloud and re-enters the cloud. That's a bullish signal, but it's not a buy signal in my opinion. It's just showing that, hey, the bulls are starting to like show a little bit more and more strength, basically. Ethereum was up 1.45%. This too has been sort of, was under the cloud, has basically entered the cloud, and it's just been moving sideways, right? So here we get that consolidation going on. By the way, I don't know if you guys know this, but Tom Lee's BMNR holds about 5% of all Ethereum coins. Let's take a look at BMNR. I'm just kind of curious to see where it's at right now. How's that doing? Oh, that's interesting. So BMNR, BitMine Immersion Technologies. Remember, Tom Lee is the, what is his title there? Chairman of BMNR. as of June 30th, 2025. So right now, that's been in an uptrend. It's moved up about 44.9%? 46.26. Okay. From this low, June 30th of this year. It's moved up quite a bit. But it also had a big pullback, right? As you can see right there. All right. So that was Ethereum and BMNR. Let's take a look at our members' requests. We've got 4. ERO Copper. So this is the one stock that actually has a blue flag, because if we look at the weekly chart, what you'll notice is price is above the cloud, price is above the moving averages. The faster moving average, the green line, crossed above the red one today or this week. The cloud itself, the future cloud, is bullish. The Chiku span, the white line, is above price. Okay, all that is happening. So I like what I'm seeing. I would say that there is going to be some resistance coming up right there. The high of that candle is 39.80. Whoops, double check that, 39.80. So let's make sure we get that correct amount in there. We'll color it light blue for the weekly. There we go. How far are we from there? We're about 11.7% or so. So that's good. I mean, that's not a bad target. ADX is moving up. There's the weekly, there's a daily chart. And what I like about this particular pattern that you're seeing here, this is what they call a bull flag pattern. So price has been moving up. Whoops, wrong thing. Let's see here. Price has been moving straight up and then built a little flag right there. Okay, and so I like that, and the fact that we gapped up today and ended up continuing up, it was up 3.28, tells me there's a higher probability tomorrow's going to move up as well. So this is a nice one. ELF, let's take a look at ELF. Beauty Inc., consumer defensive sector, which is not a really strong sector, but this particular stock on the daily chart looks pretty good here. I like the daily. It just popped back above the Tengen-sen here. It was under this morning, and then boom, a gap basically continued up. It looks like it's higher probability for a bullish trade tomorrow because of what I'm seeing here. And what about the weekly chart? Still under the cloud. So you don't have confirmation on both time frames, and that can be an issue because it's hitting its head right there at that cloud, and that is a natural level of resistance like it was here. You can see that pullback. So after that move up there, touch the cloud, came closer, and then drop. So far, it's starting to look a little bit bullish as the week begins at up 2.45%, but it needs to break through that cloud, in my opinion, against above the weekly and above the 200. Honestly, then that's about 13% away from where we are. If you don't want to hold off, hold out long, you really just have to monitor this very closely. And use the daily chart, maybe also use a 2-hour chart to help with entry and exits as well. Right now, you can see on the 2-hour, it's just kind of pulling back a little bit, but it's above the cloud. PAAS, which is Pan Amer Silver, okay, under the gold industry. But I think it's a combination of gold and silver, if I remember correctly. So let's look at this one on the weekly chart. Here it is. It's inside the cloud. Inside the cloud. So Chiku span is underpriced. The cloud is starting to potentially turn bearish here. But then the directional movement index is still bullish. So we're getting multiple, not a lot of confirmation here on the weekly. And then if you look at the daily chart, it pulled back. It's under the 200. This is something I wouldn't be adding a position in, but it certainly is something that is showing a little bit of strength because it's holding for the last 3 days above that 26 period. It's also still inside the cloud. There's a good chance that it could move up since it was up 1.52% today. What about PATH, UiPath, in the software infrastructure? Well, it was down just slightly, 0.06%, but if you look at the cloud itself, that's bullish. The green line is above the red line. Chiku span is above price. Price is above the 200. Okay, we've broken through a very long consolidation from going back to February here of 2026. See that consolidation? So we're above it, and it's expanding now on the daily. Let's look at the weekly. On the weekly chart, it broke through the cloud last week on Friday. It also, for 3 weeks now, or 2.5 weeks now, we're above the 200. Problem is the cloud is still bearish, but it takes a little time for that cloud to turn bullish. It's looking for more confirmation, and it's based on specific mathematical equations, like using the moving averages for the single span A. I've talked about it in the previous video if you want to check that out, and the single span B. So, but I like what I'm seeing overall with PATH. Weekly and daily is looking pretty bullish. It's relatively close to the Tenkan-sen. It's not too far away from the moving average here, so I don't see a fear of this thing, like, pulling back necessarily. So we'll see what happens with PATH. And guys, that's going to do it for this video. Again, thanks for supporting the channel. Hit the like button, the subscribe button. Share this video with someone if you'd like. And find out about my channel here. You can click on 10 more links, or if you click on more, you can read about me, my channel, all the links here. This is another link to join, to become a member, to get access to the portfolio and videos. Over here, the $25 coupon for TC2000, a link for the FinViz Elite. My Twitter page is right there as well. If you click on this link for the TC2000, this will pop up. You enter your email here, and you'll see that you can receive a $25 coupon towards your TC2000 service, courtesy of Blue Cloud Trading, as long as you haven't used it in the last 12 months. All right, and then there's the pricing here, software plans, basic, premium, premium plus. If you select monthly, it's $24.99. So you can try the basic out for free, or you can upgrade to the premium for more features by paying an additional $25, because it's $49.99 a month. If you end up liking it, my suggestion would be to switch to a biannual. Why? Because it brings down the price significantly. If you pay for 2 years in advance, it goes from $49.99 to $37.49 a month for the premium. Okay, well, that's going to do it. Thank you guys. I will catch you all in the next video.